Today we're going to talk about how to read your profit and loss. The profit and loss is the first financial report that most investors and banks look at. It shows whether or not the business is profitable, and if so, just how much income it can generate. The profit and loss shows the business's income and expenses for a certain period of time. Unlike the balance sheet, which represents the company's standing at a moment in time, the profit and loss can be run for a day, a month, a year, 6 years. Whatever you want to see, you can. You can use those historical financials to compare and keep your business in check and honest. The profit and loss is a way of keeping your business within its budget. So once you're sure that the balance sheet is accurate, which means that all the transactions have been accounted for, you can start to review the profit and loss. Now, the profit and loss is broken up into 3 major parts. Say them with me now. Sales minus cost of goods sold minus overhead expenses. And for the sake of discussing nearly every scenario, I'll add other income and expenses. So let's break them down one by one. Sales. When sales on the profit and loss increase, that means that you've either invoiced the client and have yet to receive the money because the other side of the transaction is accounts receivable, or money was received at the time of the sale and your business bank account increased. The same is true for sales decreasing. If you refund a customer, you want to track that in a separate account within your sales so that you can see the trend of refunds and whether they're increasing or decreasing. If you give money to the customer, your cash decreases and your sales also decrease as a total. Some business owners like to separate income streams on their P&L. Photographers will often separate wedding income from portraits and engagement shoots. Or a pizza shop with sales at the bar, in the restaurant, and at takeout, they'll want to see where the sales are coming from. Remember that the more detailed you get with your books, the more work it will be when recording transactions. If you stop breaking out income every 3 months because you didn't feel like looking up the sales breakdown, then that makes the entire process useless because you won't really have good comparative numbers within those sales. So keep that in mind when deciding what is important for you to see when reviewing your financials. My suggestion is always to start with a very basic set of books, not a ton of specific account detail. And once you start digging into the numbers and have more specific questions as the business grows, adjust your classifications moving forward. Next is the direct cost of making those sales. Now this could be a million things depending on what you're doing to make those sales. If you have people working an event with you, labor or subcontractors will be the cost of goods sold category. If you had to buy something that you sold to the customer, those purchases will be recorded either directly from your bank or as a credit card charge that you made, or they'll be manually removed from your inventory to cost of goods sold. And rarely will you find that these direct costs are reduced unless the expenses are reimbursed directly by the client or unless you return something and receive a refund back into your bank account or as a reduction of your credit card balance. Other very common cost of goods sold items include shipping, packaging, and merchant processing fees. Cost of goods sold expenses are important to keep track of separately from overhead expenses because you'll use the COGS and gross profit calculations to make decisions about the cost of your products or services, the entity's future, and the budget for your business. It's important to remember that everything in the cost of goods sold section is directly related to the sales you're generating. Things like your subscriptions, internet payments, or rent payments don't belong in this section because they'll need to be paid regardless of whether or not you make a sale. Overhead expenses are the expenses you'll have no matter what, every month, regardless of whether or not you make any sales. The deductibility of COGS and overhead expenses are exactly the same for tax purposes, but it's really important to understand what it costs you every month to operate the business for planning purposes. Your average monthly overhead number is what you'll use for projection purposes, for budgeting, and to understand if you have enough cash in your bank account to float you should you be unable to generate income for whatever reason. As you pay out money from your bank account, reducing your assets, your expenses increase. Your overhead expenses can also increase as your credit card liability increases or as your bank loan increases if the lender pays directly for expenses on your behalf. Some common overhead expenses include payroll taxes, workers' comp insurance, rent, advertising, bank charges, computer expenses, insurance, travel, legal and professional fees, auto expenses, postage, cell phones, dues and subscriptions, meals and entertainment, software, taxes and licenses, continuing education, gifts, marketing, social media, subcontractors, security, utilities. Whew. Other income and expenses. These are expenses or income that aren't common for your business and shouldn't be counted on or factored into your budget. Now, these includes fines and penalties, interest income, credit card cash rewards, depreciation, amortization. Once you've reviewed your profit and loss for the specific period and you're sure that it's accurate and representative of your actual income and expenses, ensuring that there are no negative expenses, no large expenses that should have been capitalized as a fixed asset, and no other oddities like that, now you can take your profit and loss and run a report to compare it to your budget. See how you did. Were you under or over budget for the period you're looking at? Can you roll some of those savings from coming under budget into next month? Or do you need to adjust this month's spending to compensate for your overspending in the prior month? Make sure you're using the information to adjust future budgets if needed. And understand what the profit and loss tells you about your business and your ability to reach whatever goals you've set. Now you know how to read your profit and loss. Remember that the profit and loss shows your net income, but that net income doesn't necessarily mean that you have that much cash to spend. To figure out where your cash is going, you have to get familiar with the cash flow statement. And make sure that you check out the video where I run through a couple profit and loss statements and explain a bit more about what's on them and what I see when looking at them. If you found this video helpful, we're real accountants and CPAs who work with hundreds of small business owners just like you every day. Check us out at engagecpas.com to see if we're a good fit for your business. We also have business courses available to help small business owners understand their business. They're for you to learn about your financials, your taxes, how to pick the right entity, tax myths, and everything else about your business. Learn at your own pace. Check those courses out on the Education tab on our website. You can also find us on Instagram at Engage CPAs.